In this, our 100th episode of the New Money, New Problems podcast, I celebrate by telling you the biggest financial mistakes I've ever made and, when possible, how much they cost me. Let's get started.
Let's get some money.
From New Money, New Problems, it's the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. Negotiating compensation, purchasing your first investment property, helping your family with money, the highs and lows of entrepreneurship. New money brings new problems that require new solutions. Join us as we work through them together. I'm Brenton Harrison, and this is the New Money, New Problems podcast.
Hello, my name is Brenton Harrison of New Money, New Problems, and your host for the New Money, New Problems podcast. I hope that you all are having a good week so far, and if you tuned in last week, or even if you just heard the intro a few seconds ago, you know that today is a celebration. This is officially the 100th episode of the New Money, New Problems podcast. It has been a joyous ride. We've had so many things that have happened for us in a positive way, and hopefully we've impacted you in a positive way over these last couple years or so. And before we get into this episode, I want to do a little housekeeping to tell you what it's about and also some things that we have going on. You all are aware that we have a separate podcast, the Escape Student Loan Debt podcast. It's not connected to our work as financial advisors, but oftentimes the subject matters cross over. On that platform, Escape Student Loan Debt, we have released the Guide to Income-Driven Repayment Plans that tells you everything you need to know about federal income-driven repayment plans, from how to know when you're eligible, to how payments are calculated, to interest subsidies, and there's even a calculator on the last page. And we want to make sure that for those in our audience at New Money, New Problems, for whom it's relevant, that we share it with you. So if you're interested, we'll put a link to this in the show notes. You can go to escapestudentloandebt.com/guide to download it. Once again, that's escapestudentloandebt.com/guide. We think this is going to be really valuable for those who are still struggling with federal student loans. Now, to this week's episode, it's going to be kind of like a 2-episode celebration. Next week, we're going to share some of the favorite moments that we've had from episodes so far. But in this week, I wanted to think about something that people have told me is valuable in terms of why they like the podcast. And that is, they appreciate the fact that I'm not unwilling to share that many of the topics that we discuss that people struggle with, I have also struggled with at some point in time as well. So in this episode, what I wanted to do is I wanted to tell you some of the biggest financial mistakes that I've made. Before the break, these mistakes are not going to be things that have like A to B connection in terms of how much money it cost me, but they're more just mindset things, peace of mind things, harmony in the home things. And then after the break, I'm going to tell you 5 instances where mistakes or lack of knowledge on my end led to, at minimum, a 4-figure penalty, mistake, or circumstance that we had to dig ourselves out of. And number one, we've talked about this in the past, it is not understanding the importance of knowing your hourly rate. We've talked about hourly rate on this podcast on the premise of understanding how much you expect to earn from an hour of your professional or personal time. And sometimes those rates can be different. You may say an hour of your professional time is worth $100, whereas an hour of your personal time is worth $50. But I encourage everyone to know that rate. And an example of how that's bitten me in the butt in the past actually has to do with how we priced our private client group when we first started offering it at New Money, New Problems. Technically, at the time, I was a member of the firm Henderson Financial Group. And when we started those offerings, we were meeting with people 4 to 6 times a year if they were in year one. And we set the pricing for that private client group at $2,200. And when I set that price, it was really no rhyme or reason to it. It just kind of sounded good. And when I set that price at $2,200, I also didn't do any type of calculation to figure out what my hourly rate would be based on the number of clients that we had, and also how many clients I would have to earn the amount of money that I planned to earn. So we started at $2,200 and we added client after client after client. And what I realized is you only have 24 hours in a day. You can only have but so many meetings in a day. And as I was trying to scale up our business at $2,200 a year, what I realized is it would take so many clients that we would have have to add at 2,200 for me to make a living, then not only would it not be sustainable in terms of, oh my goodness, I'm waking up at 5 in the morning having meetings and going to bed at 11 o'clock at night from having meetings. But I also realized that if I were to even reach that number, it would put me in a position where I would have so much to do that I couldn't even honor the promises that I'd made to the people who signed up for the private client group. And when I did the calculations, I said, what would it be like if we had 75 families at $2,200 a year on this plan? What I quickly realized is when I did the math on what I would be earning for my hourly rate, it was an amount that was just unacceptable. And had I, before releasing any product or service, done some calculations to say, here's how much I want to work. If I work these many productive hours and I make this, what is my hourly rate? It would have given me more perspective in terms of how to set those service prices in a way that honored what I expected to earn in my professional life. And if you're a W-2 employee, this concept is still the same. It may not be that you're setting the price for services, but it may be that when you calculate your hourly rate, you find out, hey, I hate this job. And there's plenty of jobs that pay this hourly rate. So if I don't enjoy this career, maybe it wouldn't be that much of a switch to find something and pivot to something that I actually do enjoy, because the comparable hourly rate is something that's more easily attainable. Or if you enjoy your industry but want to earn a higher hourly rate, you can chart a path for what type of training you need to do, what type of relationships you need to make to put yourself in a position where you can earn the hourly rate that you choose. When it comes to your personal life, the value in knowing your hourly rate, we've talked about me switching from ironing, folding, washing clothes. I don't do it all myself. My wife does it too. To doing wash and fold every single week. And every single week, I've gone from doing wash and fold to now there's some things that I want to wash at home because it may be something that's precious to me in terms of an article of clothing. And I'll drop stuff off at the laundry just for fold only, because it is that much of a time saver where the $30 to $40 that I spend a week saves me 3 to 4 hours of time. And I for damn sure expect to earn more than $10 an hour, which means it is not an efficient use of my time to do it on my own, and it is an excellent exchange of value for me to pay someone to even just fold those clothes for me. So mistake number one, not understanding the value of knowing your hourly professional and personal rate. Number two is a harmony in the home scenario, and it has to do with marriage. If you are sharing your life with someone and you are sharing your finances with someone, you know that that is a very difficult thing to do. And it's something that my wife and I have struggled really for the entirety of our marriage to find a way to manage our finances together in a way that makes us both feel informed, empowered, and on equal footing with each other. And that was a tremendous struggle really, really early in our marriage, because if you think about it, I work hard, my wife works hard, but I work in finance. So there's already a built-in assumption in my mind that I know what I'm talking about, which already builds an assumption in her mind that I feel that she doesn't know what she's talking about. So we tried for years to keep our finances together. We had both of our paychecks deposited into the same account, and we would try to both manage the expenses that were coming out of that joint account when it comes to bills, when it comes to expenses, and also try to figure out how to use that card responsibly in a way where at the end of the month we knew exactly how much we were going to have to pay off. And it was a nightmare. We would have constant arguments when it came to finances about, why did you charge this? Why did you charge this at this time? Her issue was, you didn't tell me or communicate to me when was a good or a bad time, so how do you expect me to walk about day to day knowing that when you're the person who's managing the expenses? And the power dynamic put it in a situation where it always felt like I was some, father over her shoulder, as compared to a partner who's saying, I know that you're working hard. I know that your intention is not to do something in a way that bothers me. And you couldn't have known that it bothered me because I haven't communicated it to you. And I think that in our efforts to do things together, we had this assumption that if we were to handle our finances separately, that it was some indicator of marital disharmony, right? If we have separate accounts, then that must mean that we're on the rocks, because every good couple just works hard so that they're on the same page financially. And it took us having conversations with, at the time, her 95-year-old grandparents, and hearing them say, we have been married for over 70 years and we have always kept separate accounts because he likes to nag and I like autonomy. So when you hear this person who has a whole lot of wisdom and a whole lot of age and a whole lot of successful marriage say it is okay to handle things separately, as long as you're transparent with each other and as long as you're working towards the same goal. It gave us the freedom to look at each other and say, how about we try this a different way? So now we have separate accounts. Her paycheck gets deposited into her account. My check gets deposited into my account. We have set bills that each of us have signed up to pay, and we each have separate credit cards that we're responsible for on our own, and we have joint goals that we contribute to towards the house on a joint basis. So now, instead of trying to manage our expenses together, all we have to manage are the expectations that we've set in terms of how we're going to save or what joint debt we're going to pay off. So it has worked wonders in terms of our willingness or ability to have conversations about finances together. Marriage is hard separate from that, so it's not like we've never had an argument since we've done it. But at least in terms of our understanding of our partnership, the biggest mistake that we made early is assuming that the only way that you can be happy is by doing things together. When upon experience, I can say that you can be in a perfectly harmonious relationship and still decide that to stay in a harmonious relationship, it would be wise for you to manage some things together, but to have some autonomy where you manage some things separately. And then number 3, and this is one, it's not A to B, but man, I wish I would have had this understanding at an earlier age in my career. This is my 15th year in financial services, and I would say for the first 12 years, I would speak somewhere at least once every 6 weeks. A church, a community center, a webinar, and I often did it for free, which is not necessarily the problem. But the problem is I have met thousands of people over the course of those first 12 years. And when it came to how I followed up with them, it would basically be just me posting my information on a wall or on the screen or on the laptop and saying, if you want to reach out, email me. And in reality, if you have a room of 100 people and you tell people to email you or reach out if they're interested, you'll probably have 3 who will reach out, and you'll probably have 1 or 2 of those 3 who actually follow through to even set an appointment, much less become a devoted person in your community. What I wish I would have understood is that when it comes to building a brand for yourself, everyone needs to do it, whether you're a W-2 employee or a 1099 employee. And one of the quickest ways to build a brand for yourself is to put out content. And one of the stickiest ways to produce content is through email. I had a person who I've worked with, his name is Thomas K.R. Stovall, who helped structure a lot of the things that we do in New Money, New Problems. And one of the things that he told me about email addresses is when you're trying to build your profile through social media, they can always take your algorithm away. Instagram or TikTok or YouTube can change an algorithm, and all of a sudden the reach that you fought so hard for is now being suppressed. But when you have an email address, it can never be taken from you. It is the quickest way to get to people who are in your target market or in your target community if you're W-2 and are trying to climb that corporate ladder. And having that address is something that you can take from platform to platform, and unless a person unsubscribes, putting out content to them is going to have a higher conversion rate that cannot be taken away. So if you're a W-2 employee and you are just at a networking event collecting cards, if you are building relationship at conferences, even if you're not planning to do a newsletter, you have no idea the value even 15 years down the line of having a collection of email addresses that you have categorized and can reach out to if you need a new job or if you're trying to sell elements of your current job. There's tremendous value in not only documenting where you've been, but also collecting the information from people who were there with you. And it's something that has cost me an unknown amount of money because we have, thankfully, a decent sized email list, but who knows what it would have been if whenever I went and spoke at a community center or a church, I just had a pen and paper that said, please write down your name and email. And if you want to unsubscribe when I reach out to you, feel free to do so, but we're going to collect those email addresses. So those are 3 broad scope things that have cost me an undetermined amount of money. After the break, I'm going to share, I think 5 things that have cost me a very specific amount of money and share what I learned. We'll be right back.
This is the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. We'll be right back.
Are you wondering what new money problems you might be overlooking in your financial life? If so, we've got great news. We've crafted the New Money, New Problems Gap Finder to identify potential weaknesses in your finances in areas ranging from budgeting, investments, insurance, and even the threat your extended family's finances could pose to your household. Please head to newmoneynewproblems.com/gapfinder to complete it today. Again, that's newmoneynewproblems.com/gapfinder to take the assessment.
You're listening to the New Money, New Problems podcast. Subscribe now at newmoneynewproblems.com. Welcome back.
All right, let's get into it. Mistake number one. We have talked about employee benefits on the podcast, and one of the things that I've warned you about is health insurance and health insurance plan years. And what I say by a plan year is when you think of a year, you think from January to December. And with health insurance, it's very regular in terms of a health insurance plan year for it to go from January to December. And what that means in the context of a plan year is it's the time in which they are assessing how much money you've spent towards your care. Have you paid X amount towards your deductible? Have you paid X amount towards your out-of-pocket max? And we judge that between January and December. So for example, if you have a $2,000 deductible, then if you spend $1,800 between January and December, they're looking and they're saying, hey, they only have $200 left in their deductible. Well, what I didn't know when we were pregnant with our son, I should say when my wife was pregnant with our son, is that not every company has a health insurance plan year that goes from January to December. And at that time, I would imagine it's similar with most OBGYN offices. The OBGYN to which my wife would go for care required us to prepay for all of the expenses related with her providing care before the 16th week. I think it was at the time, it was like $1,800 that we had to pay towards her care, and we had to make that final payment by the 16th week, and if we hadn't, then we just couldn't go back to that OBGYN again. So we spend that $1,800. Matter of fact, we had gotten up to the point where we had basically gotten right up to our out-of-pocket max in the second trimester of her pregnancy, which was January to March or so. And in my mind, I'm thinking all of this is going to fall within the same plan year because we spent towards our out-of-pocket max. It doesn't end till December. So by the time that the baby comes around, we're not going to have to pay much of anything for the cost of her going to the hospital. What I was unaware of is the fact that her plan year for her company health insurance went from April to March. So in reality, when we paid all those funds and got close to our out-of-pocket maximum, after the end of March, the plan year completely reset. So when June 1st came around and we went to the hospital and ended up being in the hospital for 2 extra days, none of that had been paid towards our deductible or our out-of-pocket max. So 2 weeks after our son was born, we got a hospital bill totaling over $8,000 that had to be paid within that plan year. But had I paid more attention to the plan year, I would have at least started putting some more money aside prior to his birth with my wife to make sure that we were better prepared, because when that expense hit, we were very ill prepared and it was an unpleasant surprise, especially with a newborn child. That's number one. Number two, over-optimizing my budget without understanding the risks that come with doing so. We've talked about the fact that we've had a couple of home repairs, unexpected home repairs in our home over the past couple of years. What I did not share is that our deductible when we bought our current home was $1,000 when we started. And as a result, our premium on our homeowner's insurance was pretty high because we'd only have to pay $1,000 and then the company would step in if anything got fixed. And when we moved into that home, our mortgage was more than double what we had paid on our previous property. In my mind, I was trying to optimize and find money wherever I could, and the easiest place I could find was the homeowner's insurance policy. So I increased our deductible from $1,000 to $2,000. Now, after I increased that deductible from $1,000 to $2,000, we had 3 separate incidents where we had to file a homeowner's insurance claim. And because our deductible was now $2,000 each time, we had to pay $6,000 before the company stepped in, as compared to the $3,000 that it would have been if we had kept it where it was. But another thing that we didn't do is, if I had thought through it and said, now we're putting ourselves in a position where if there's a concern, we have to cover more of it, what I would have done is I would have paid for a home inspection to identify any of the things that hadn't been repaired, needed to be replaced, so on and so forth. But I didn't do that. And I did not know that the way our roof was structured, if there were ever a heavy rain or a storm, we might have some problems based on really a plastic guard that should have been under our shingles that was not placed under our shingles when it was built. This Martin Luther King Day weekend in Nashville, we had a tremendous snowstorm, and we had over 8 inches of snow that piled up on our roof, and when it melted, our roof had a tremendous leak that came all the way from the roof down to the first floor of our home. And because this was something that was our error and was not covered by homeowners insurance, it cost us $9,500 to fix. So the damage that it caused inside the house was covered, repairing the ceiling and all that different type of stuff. But the roof damage was something that was not. So we had to pay the $2,000 for the claim for the stuff inside the house and $9,000 plus to repair the roof. So there is a level of optimization where if you're not realizing by optimizing this, I am opening up a risk somewhere else. Where in my scenario, I wish that I would have gotten a home inspection, even if it cost me $1,000 or so, and had the peace of mind to know that if anything were to occur, yes, we're on the hook for a higher amount, but we've done the best we can to identify those risks ahead of time. And if you're keeping track, we're at almost $20,000 of mistakes that I have made so far. So let's add to that total. Next up, payroll taxes. And taxes are something that can trip up a W-2 employee who already has most of their taxes withdrawn from their check, but it can definitely more easily trip up a 1099 independent contractor. And even beyond that, it can be more confusing for someone who goes back and forth between W-2 and 1099 income. And for the early part of my career, that's how I was compensated. When I came into this industry, I came in through an organization that was a member of John Hancock Financial Network. And as a result of that, in terms of the way I was compensated, a lot of it came through John Hancock insurance policies. And when you offered those products to your customers, you would be paid as a W-2 employee by John Hancock. But it was also what's considered open architecture. So while you did get compensated as an employee for John Hancock products, you had the ability to offer other services and products from other companies if your client had the need. And when you did operate in that capacity, they, instead of paying you W-2, would pay you as a 1099 contractor. That's important because, going back to our episodes on taxes, when you're a W-2 employee, you have a certain amount that is withheld from your check. That's why they ask you to fill out a W-4. But when you're a 1099 independent contractor, you have to pay your taxes on your own. And what most people do is they have a separate account where they might set aside a certain percentage of their check so that every single quarter they can pay their quarterly tax payments to the IRS. And when I started getting paid in both capacities, first off, I was in my early career as a financial advisor, and I don't know what you heard about financial advisors, but if you heard that they make a lot of money when they start, you are mistaken. So it really didn't matter that much if I put aside money for my quarterlies from that 1099 income when I started, because there just wasn't that much income to be had in the first place. So from year to year, I would file my taxes, have a certain amount that I had to pay, but it wasn't a significant amount. And thankfully, whatever I had been putting aside had not been so inconsequential that it became a burden. Well, after I'd been used to getting paid that way for a few years, they started to phase out that style of compensation. They moved us into the role where we were all independent contractors, and there were no incentives, whether you did your insurance with John Hancock or MetLife or whomever. All of that went away. And instead of having a portion of my income for which I was paid as a W-2 employee, I now went to 100% 1099. And I went through the entire process like I had in years past, where I would take, say, 20% of what I was paid. I would put it in a side account for taxes and just assume that I would be okay. But what coincided with that switch in compensation was also an increase in my compensation. I started making more than I had in years past because thankfully I was starting to find my footing in this industry and just get paid a little more. And if I had paid attention and had a better knowledge of taxes, even in those years where I was making less money, I would have also understood that when you're a business owner or when you're an independent contractor, you not only don't have federal income taxes withheld from your check, but you also have to pay 100% of the payroll taxes that are associated with what you're paid. And this is something that a lot of people don't realize. When you look at your check, there are two different types of taxes that are often taken out. There's Social Security tax, which goes towards what you're going to receive in Social Security payments when you're older. And then you also have Medicare tax that makes sure that you have Medicare available to you for health insurance when you're in your retirement years. Now, when you're working for someone, the employer is required to cover half of your payroll taxes. So the Social Security tax is 12.4% in total. That means that you as the employee cover 6.2% and your employer is covering the other 6.2% on your behalf. And when it comes to Medicare, the base tax for Medicare is 2.9%, meaning that 1.45% is paid by you as the employee, 1.45 is paid by the employer. I was paying my half of those taxes for the W-2 income I had made in the past, and I was covering 100% of those taxes as the employee-employer for the 1099 income, but the income was so insignificant that I didn't recognize it on my tax return. But when I went to 100% 1099 income, and now all of my income is getting taxed for payroll taxes at about 15% on top of federal taxes, now that's a level of planning that I was not aware that I had to do. And when I got to the end of the tax year, I set aside the amount that I thought was appropriate, but I got stuck with an extra bill for $7,000. So when you hear me talking on this podcast about the importance, even if you don't consider yourself a tax professional, of understanding how your taxes work, it's not because I just want you to nerd out on IRS language. It's because I have personally been burned by not understanding the impact of entrepreneurship, ownership, and how it impacts your taxes as compared to when you're an employee. And lastly, and this one hurts because it is by far the biggest expense in terms of what we missed out on as a family. When my wife and I got married, we actually, as odd as it may sound, had a rental property before we bought our primary home. So we had a rental property. We bought our primary residence. We were both earning, seeing as the fact that we didn't have a child and very little responsibilities, good income at the time. Now, my wife, after we had purchased our primary residence, switched jobs. She started working as a personal stylist and she was making good money as a personal stylist. So our household income did not decrease in this job switch. It actually increased. And because we had no responsibilities, I said, this is the best time to go try and get another investment property. So we're in Nashville, Tennessee. If you're listening in Nashville, you'll understand the importance of what I'm about to say. If you don't live in Nashville, just understand that this area at the time was not that big of a deal, but now it is one of the most expensive areas of town. There's a part of Nashville called Germantown that bleeds into a part called Salem Town, and we came across a property, a 3-bedroom, 1-bathroom rental property that was on sale or being listed on the market for $117,000. For a frame of reference, if you bought a plot of land on that much land today, that land alone with no house on it would probably cost you $400,000. So we saw this as our next property to add to our portfolio. We had people who even wanted to rent the property. We go to a lender and we try to put ourselves in a position where we can qualify for this home loan with the expectation that we have enough debt to income ratio to service the loan, no problem. And we did have enough debt to income ratio, or I should say a positive enough debt to income ratio to service the debt if they would have included both of our incomes. But what I was unaware of at the time is that with most lenders, for any job, regardless of the type of job, you often have to have at least 1 year at that profession, unless you're like a physician or an attorney, before they will consider your income in the calculation. And for certain lenders, that requirement for a sales or commission-based income can be as long as 2 years. So when they looked at our debt to income ratio, if both were included, we'd be fine. But because my wife had just started the position, they would not consider her income in the calculation. And with my income not only being sales oriented, but also being very volatile and cyclical, they said that they would not give me the loan or us the loan unless we had a cosigner. So we have this home, $117,500. We have people who are willing to rent it. All I have to do is swallow my pride and go to ask someone to cosign on the loan for us. And my parents offered to cosign on the loan. It wasn't going to cost them anything. They weren't going to have to put anything into the property. They were literally just making sure that this house that we wanted did not fall out of our grasp because of something as simple as just needing a cosigner. And I said, oh no, I want to stand on our own 2 feet. We don't want your help. We are grown now. And I was not able to see the forest for the trees. And we told them no and decided to just not get the property, right? I'd rather have no property at all than say that we have a rental property, but the only reason we got it is because my parents helped me out. That was my foolish thinking at the time. So that house that was $117,500, it sold. And within 5 years, the person who purchased it tore down the house, got it rezoned, and put 2 different houses on that same lot and sold each of those houses for a minimum of $375,000. And that could have been our opportunity if only I had understood that when you see most people out here who have earned or are earning a tremendous amount of money or who have a tremendous amount of assets, it is highly unlikely that they got there all by themselves. And if I had understood that, I probably wouldn't even be making this podcast. I'd be somewhere in my early retirement years enjoying my family. I still enjoy my family. But man, I could have really, really enjoyed my family with a little more free time on my hands if only I'd been able to humble myself. So those are some of the biggest mistakes that I've made, and I don't list them off for fun. Trust me, it's not fun calculating this and going through what it costs, but it is to say that there are some things that you have to go through and learn from in order to get the lesson. You can have somebody tell you something financially, but sometimes you have to touch the stove. As my friend Will Radford says, sometimes you have to pay tuition into the school of experience. And my hope is that as I continue to make mistakes, because we're not perfect, that you learn from them and have something to not just have for yourself in terms of what to avoid in the future, but in my case, some things that I can pass on to you and add value as a listener of the New Money, New Problems podcast. And I hope that we've done that over the last 100 episodes. It's been something that's not the easiest thing to do in the world. And I want to let you all know that I so appreciate the people who have made a random comment to let me know that they're listening or following the content or told me to keep going. That is the type of stuff that makes it easier to sit and record these things when maybe you feel like taking a week or 2 off or stopping the whole thing together. So we're not stopping. We're going to continue for another 100 episodes and more. So thank you so much for what you've meant to us as a community. And we look forward to seeing you and continuing the celebration with part 2 next week.
From New Money, New Problems, this was the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen.